Good morning, folks. It's Saturday here, the March the 8th at 5:30 in the morning. We're just doing a quick 10-minute overview of the past week. Man, what a crazy week it has been. Chaos and fear and just madness everywhere. So we're going to start right away with the VU, my beloved Vanguard S&P 500 index fund. As you can see, it's down about 3.4% this past week, and it is insane. Down 4% the past month, and then down about, the past 6 months. You guys zoom out and go back 6 months, we're still up 5%. The S&P 500 as well, similar story, of course, down 4%, down 3%. The Nasdaq has seen, I think, a bit of a bigger sell-off, if I remember my research. Past 5 days, I'm going to refresh this. So yeah, the past 5 days, the Nasdaq's down a lot more. But the point is here, there's just crazy fear in there. The volatility index has been literally kangaroo market this past 5 days. Even the past month, past 10 days, it's been like an absolute kangaroo since the 21st here. It's been up and down all over the place, primarily driven because of Trump's tariffs. Like, will there be tariffs? Will there not be tariffs? One day he seems to say tariffs are going to be happening, and then next day tariffs will be suspended. So the tariffs against Mexico and Canada are now pushed back to April the 2nd, not April the 1st, because Trump's superstitious, April the 2nd. And now, of course, the markets are responding to that with more volatility, which caused this spike. And Scott Bessett spoke as well about how there's going to be a detoxing period with America, the stock market, and the economy, that the American economy has become addicted like a drug addict because of government spending on the stock market, on the economy. He's literally said there'll be a detoxing period, so pay attention to that. There's going to be, I think, a lot of pain to come. We're only getting started. It's only the second month of the year, March now, the third month of the year. I think they're inflicting maximum pain here because of COVID-19, because of the past couple of years of just reckless spending, reckless abandonment, and the war in Ukraine, COVID-19, printing money. We can look back here in the federal funds effective rate, of course. I don't want to sign in. You can see here before COVID-19. Let's just remind ourselves. When did COVID start? It was 2019. What day was it? January the 18th of 2019. Okay. This AI needs to be better than this. But you can see it here. COVID hit, and then we started this massive sell-off of the federal funds rate down to these 0%. I refinanced my first home right here, which is awesome. Got a fantastic 2.9%. And then we moved to Florida in 2024. Sadly, we bought a new home here with a 6.9%. We'll refinance that as long as this comes down again. But you can see this. Look at what's happened here. They printed billions. They flooded the market with trillions of new fiat currency, and that has caused a huge increase of the stock market. I'm going to call it bloatation, bloated beyond belief. And we'll change this to the 1 year. And finally, it's started to, the federal funds rate has been coming down a little bit. The Fed officially pivoted last September of 2024 to cut rates, which is a very interesting point. They're now cutting rates, and that means we should expect to see some sort of response to the market this following year. So we're 6 months into their official rate cutting, and we've got a new president, we've got new fiscal policies, everything is changing. So be aware of this. The whole game is changing in front of our very eyes, and if you're not following this, if you're not prepared, if you're not paying attention, you're going to get hurt. My personal investing philosophy, not financial, not advice, of course. Stay invested. Go long term. Get into bonds if need be for protection, and get into some really good index funds like the VU, because we're into maximum pain territory. Things are not good. There's a lot of fear and panic, and people are scared. We want to educate ourselves and each other to do what's best for all of us, okay? And then future Fed rates, CME rate cut probability. So you can look at this. This just shows you that how likely is it that something's going to change, right? So our current target is 425, 450, and we have about 88% of staying in that bucket. We got 12% chance of going down to a lower rate cut. Now the problem here is that's changed. 1 day ago we had a higher percent chance of change by 2%, and then we also 1 week ago we had 8% change, if I'm reading that correctly. So you can see these things are changing month to month, and as we get new data, if we zoom out to maybe let's go to May. Likewise, you can see how May has had a change as well. There's less and less and less chance here of a rate cut. And that's because of we got some good data came in this past week that we'll jump to real quick on Friday, March the 8th. I would like to go back this past week, previous week, thank you. So yeah, the non-farm payrolls came in line pretty okay. I mean, forecast 150, consensus 160, previous 125, the actual was 151. So that's okay. It's decent. Now the question is how many of those jobs were, in my opinion, fake or not real. Unemployment rate spiked by 1%, sorry, 0.1%, not huge, in line. That's good. So the market was happy to see this. The Fed, Jerome Powell's happy to see this, and more decent data down here. Nothing that was terrifying. Nothing that was scary. The biggest news was Fed Powell spoke, and as he spoke, the market recovered. As Trump spoke before that, the market dropped significantly. And as Scott Bassett spoke, the market also dropped. So that's interesting to me. You've got the Trump and you got the leader of the economy, Scott Bassett, saying stuff to cause the market to drop, and then Fed Powell taking more of a neutral kind of line to encourage the market. So there's a lot of geopolitical stuff happening here that's going to affect your bottom line. And then we'll go over here real quick. We'll look at a few more items fast. Bitcoin. They announced a strategic reserve, an official Bitcoin strategic reserve, but they will not be buying into it heavily. And Bitcoin, again, Kangaroo market is up and down this past month like mental. I mean, at this point, you might as well just buy the dip and then sell when it recovers a bit, right? I mean, buy here, sell, buy here, buy here, sell, sell. I mean, it's just crazy up and down volatility. And where's Bitcoin going to go? We don't know. I mean, is it going to go back over 100K? Possible if they figure out how to get more Bitcoin into the reserve without spending American dollars on it. Maybe some sort of crypto tax or some sort of crypto asset pool bonds where I can buy into it and get a slice of the pie, if you will. And I know it's going to be highly volatile, so I'm fine with that. So there's ways they can do that. And let's look at the Mag 7 real quick. Tesla is the big one. We're going to open up the super graph, this guy real quick, because Tesla it's in trouble. It's officially under the 200-day moving average, and it's going to stay under here for a while, I think. And if it stays under here for long enough, this then becomes the new resistance. It'll most likely fill in along here for the next, I would say, a week or two. That's where I think it's going to behave. Can I just do this? Yeah, we can. Cool. So I think it's gonna you might see something like this for the next few months, 6 months to a year. You might see something like that. I think a lot of us do think we'll see a spike down to test this range. Now, if it breaks this range, then we could be talking about Tesla down again into the sub 200s, into the $100 range. So huge buy zones for sure. So keep an eye on that. You want to be looking at high valuable stocks you can pick up for cheap. But Tesla's in a lot of pain, of course. And then Apple, you got a lot of Apple stocks, so I've got to cover it. Thankfully, nowhere near their 200-day moving average. In fact, Apple is seeing people flood into it for protection. It's a bit of a relief from fear, from panic. As other markets were falling, stocks were falling, Apple was actually going up. So that makes me happy. Bit of a hedge there, which is nice. And with all the cash they have, and very strong, very stable, very big, very profitable, I think Apple's fine. I'm not worried about it. If Apple ever breaks this, then I'll be scared. I might have to sell, but we'll see. Not worried about it. And then we'll go over here again. Just want to look at the VU and highlight this. If the VU stays underneath or anywhere close to its 200-day moving average, this is a problem. And when you put, I wish we could put on top of this the yield curve and the historical data. I think I have a picture. Let me find it real quick, because you want to be paying attention to overall data. Here we go. Courtesy of a YouTuber. Yeah, I forget their name. He goes, the Clearview tax guy. Follow him. He's fantastic. But they did the first rate cut whenever it happened. Of course, you can see some historical data here, and maybe make that a little bit smaller. Get it all on the screen. So this is interesting because it's been 6 months since the date of the first cut by the Fed back in September, and the subsequent year, you have an overwhelming predominant majority of significant increases that first year. There only is what 1, 2, 3, 5 instances in history where the first year you're down a little bit, and then 3 years you're significantly up. There's 3 years where you're down after the first rate cut, and then after 5 years you're always in the green. Now the only thing that concerns me with this is it's been a crazy past year and a half since COVID-19, 2 years. So are we potentially more in this territory? I mean, it's possible, right? You had the dot-com bubble, I believe, if I remember correctly. You had the housing market crisis here too, Great Recession. I mean, COVID-19 stimulus recession, we can call it, could be the biggest one yet. So there's always a chance that we see this play out for 2 years, possibly 3 years, because of just how manipulated and fake the market was. Now, in the positive side, we've got AI, we've got robotics, we've got age of abundance, we've got crypto and Bitcoin official reserves. We've got a lot of stuff to be positive about, but we cannot be ignorant. We cannot ignore the fact that our government was out of control the past few years, and we've got huge problems too when it comes to Ukraine, the war, Russia. We've got $350 billion given away, and we also have Iran beginning to talk more about nuclear. So there's always things to be scared of. And every year is different. Every 4 years is different. Every recession is different. There's similar patterns. There's definitely similarities in structure and flow, but there's different nuances, and we want to pay attention to those nuances to try and spot the differences. But this is encouraging. This signals to me that we're in a buy zone, or we're very close to a buy zone, because we really want to capture as much of these upsides as possible in a 3 and 5 year time frame. The 1 year, I'm not really worried about that. I mean, I have a more than a 1 year investing mentality, so it's the 3 to 5 year that interests me. So if I can capture like this, sign me up. So pay attention to that. Some awesome data there by Clear Value Tax, and hope you all have a wonderful day. Do your homework, do your research, keep an eye on these things. There's a lot of good data here on the Fred website, we call it economic data. Keep an eye on this because you want to see the 10-year rates come down as well, for example. And I forget how to find it, but anyway, peace. Have a good day.